Hey, it's me, Anton. Welcome back to my channel. So today's video topic is market indexes and index funds. So we're gonna go through basic concepts. What are market indexes and particularly stock indexes? Then we're gonna go through what are index funds, how are they comprised, how do they work, and then finally we're going to discuss the most lazy, hands-off, but yet still efficient way of long-term investment into the index funds. So let's get started. All right. So if you're new to stock markets, you still probably have heard of S&P 500 index or Nasdaq Composite Index. So what are these indexes and what do they show? By definition, a stock market index is a theoretical portfolio of investment holdings that represent some segment in a financial market. To put it simply, each stock market index is comprised of some certain amount of stocks of companies that these indexes are constructed from. For instance, let's take S&P 500 index. This index has top 500 US-based businesses from different industries. And to be included into the S&P 500 index, each company should qualify with some certain requirements. For example, each company should be at least $11.8 billion in market capitalization. And thus, S&P 500 index is comprised of top US companies from each industry, and there is 12 different industries represented in S&P 500. So every company included in this index is a leader in their industry. So basically, S&P 500 is like a pulse of stock market health. If we take Dow Jones, for instance, it's a smaller index in terms of amount of companies included in it. It has just 30, but Dow Jones has different requirements to be included in it, and it has industrial companies. A Nasdaq Composite, for instance, includes mainly tech companies. So these three indexes, Nasdaq, Dow Jones, S&P, they're the most popular US indexes which represent the majority of US stock market. Each index has a different value, and its value is derived from the value of underlying companies. Okay, now we're over the theoretical part, yeah? So everyone knows that market indexes based on historical performance are rising over the years. So, okay, let's say you want to invest into the stock market and you want to see the same gains that S&P 500 will see in the future. That's where index funds come in. So you cannot trade market indexes by themselves because they're just a benchmark for stock market. However, there are mutual funds and ETFs that are designed in the way to mimic or follow very closely these benchmarks, and they're called index funds. Index funds are passively managed, meaning they just buy companies that are included in the underlying index, and then they move just like the index moves. If the index goes 1%, the index fund goes down 1% as well. And if it goes up 5%, index fund follows this movement exactly. Alright, so what's the difference between an ETF and a mutual fund that both are index funds? There's not much of a difference between them, except for the fact that ETF is traded like a stock. You can buy or sell it within a day multiple times, whereas a mutual fund can be bought or sold at the end of the day. So it has a 1 per day price settlement. Yeah, but both mutual funds and ETFs that track indexes, they're basically the same. The thing that you need to care about are fees, expense ratios, and transactional fees. But you can easily check these at the website of mutual fund or ETF issuer. So for example, hey, look at that. Fidelity Zero Large Cap Index Fund. So it does not track index per se, but it tracks 500 large cap companies. And this is a mutual fund that has zero expense ratio, 0%, and no transaction fee. So this would be the cheapest one if you want to follow large cap companies' performance. But I personally invest my money in ETFs because they're just easier to buy. So let's take, for example, this Vanguard S&P 500 ETF. So this particular ETF just mimics the movement of S&P 500 index. So if in the upcoming 10 years S&P moves 20% up, this ETF will also go up 20%. This particular ETF has an expense ratio of just 0.03%, so it's very cheap and it's just very easy to invest into. So I recommend this website named ETF.com for anyone who wants to buy an ETF. Here you can see every existing ETF. It's very easy to find what you want. You can find basically every major index ETF here from different issuers, so it's a golden source for you. So let's just sum up. Investing into index funds is probably the easiest way of investing into the financial markets. So when you do that, you diversify your portfolio, meaning you invest into the index that has many different companies included. So you're buying utility companies, tech companies, transportation companies, basically every industry that exists. You just buy top companies from these industries. Then what you need also to acknowledge is these index gains are not that crazy. So if you do buy ETFs, you should buy them for a long time. So just regularly buy more of the ETF. Every month some part of your money should go into the index fund, and you should not care about every day or every month volatility of the market. Just invest into the index fund for a long term, 20-30 years. If the index goes up, which in past it was going up, so hopefully it will in the future, you will be fine. You will save and you will compound a lot of money for a retirement. So this method of investing is for you if you are not that interested in financial markets, if you do not want to do any analysis, if you just can't be bothered by fundamental analysis, by performance of the companies, you don't care. You just take your money and invest into the index fund. This is like the easiest, the laziest, but yet effective way of investing your money. Still much better than just lying on your bank account. And if you want to enjoy much higher returns of your portfolio, if you want to outperform the indexes, then, my dear friends, you need to spend much more time researching the markets. And what does this mean exactly, and how to do a research, that we'll cover in the next video. So I hope you enjoyed this video, I hope it helped, and stay tuned. See you in the next one. Bye bye.